Hey guys, Freaky Finance here. Last week we looked at Oceania Gold. And this week, because earnings season has gone in full swing for this week and the next one, I'm just gonna do updates. Usually around this time I get swamped, so I gotta, instead of looking at new ideas, I kind of gotta maintain the ideas I have because I still have probably too many positions for me to keep track of. So this kind of helps me in this exercise. Anyway, so I'm gonna go through 10. There's really about 20 last week, but I'm gonna go through 10 and try to get it done in 20 minutes. So let's hope we can get through this. So first one, Capri. If you remember that video, Versace, Jimmy Choo, Michael Kors were the three segments, luxury side. And as we know, luxury's been doing really well. I don't know if you guys saw Louis Vuitton. They're just destroying it. So is Capri. So Capri put up 145 in the quarter for earnings. If you run rate that, that's almost $6, which is quite a lot because the share price is still in the 55 range. Technically, you're less than 10x earnings. Which is funny because when you look at the chart, if you were just to pull it up, it looks expensive, like you missed the move. But the thing is, this company could easily get to like $90, right, a share, just on these numbers that they're putting up right now. The thing that surprised me is because I knew Versace, well, I thought Versace was going to do well, but the whole brand did well, which is kind of weird because that could just tell me that luxury in general is doing well and not just Capri executing, right? So we'll have to see over time what happens. But anyway, Versace destroyed it, right? 158%. And some of these comps are going to be easier because of COVID, but luxury has just been on fire. So anyway, Versace just destroying it, and at the same time, revenue's going up, their margins expanding. That's what we wanted, especially as they focus more in Asia when we did the video. Anyway, so they're growing on both, the margins are expanding. The thing that surprised me is Jimmy Choo also expanded quite a bit, and they actually have a weaker margin, so I'm surprised they increased 7.7% quarter over, or year over year rather. It's pretty amazing, right? And revenue still the ridiculous comps. And even Michael Kors, which was kind of struggling before COVID, at least for the last year going into it, has really looked to turn it around. So we'll see if that's sustainable. Maybe that's just luxury in general. My real play is with Versace in Asia, right, for this company. But all 3 are firing, so that's why their earnings were better than I thought they would be at this point. All right, next one, Suncor. So Suncor put up numbers on Thursday. They were really good. The funds from operations are back to 2.3 billion in a quarter. That's a far cry from the 498 million or 88 million they put up during that COVID year when I did this video right after Q2 2020, and it was just they were getting destroyed, right? Because their average WTI was like 27.68 or something. But anyway, operations are back to where they were at 2019 levels, which was pretty amazing because this Q2 was a refinery cycle, like an upgrader. So they only used 70% of their refining capacity because they're doing their maintaining capex during this quarter. One of the things I thought was interesting on the opening notes, they said this is the best 8 months. So Mark Little, the CEO, said best 8 months of production in 50 years. So yeah, their refinery, their production's coming back online and the prices are there, right? Just that their utilization for the refinery in this quarter wasn't peak because of the maintenance cycle. But anyway, you can see to pull up the net earnings, you're swinging from like negative 1 billion the year before to plus 1 billion this year. Kind of a ridiculous year-over-year comp, but that's what we thought, especially when you look at the right here, you can see the average WTI for the quarter. They realized 27.85 in the prior year versus 66.05 today, and right now WTI is still over 70, so they're likely to put up even superior numbers in Q3 2021 given where oil still is at, and that's with refinery utilization coming back on heavy. Anyway, one of the things that they got hit with was this Fort Hills site. They were supposed to get this Fort Hills on 2 trains instead of we're still stuck on 1 train for basically 5 more months, and the share price got destroyed that day. The earnings went down like 3%, and then it went down another like almost 2% on Friday. There's a 5% move, and that's not small on like a $36 billion company. Really, it was like over $60 billion company before COVID. But anyway, so it got smoked for like $2 billion in market cap, or at least one, which is funny because literally it's only 30,000 barrels or 20,000 barrels a day. It's only delayed for 5 months. I'm really excited about this one from the market reaction point of view because all the media headlines, all they seemed to get was that Fort Hills was delayed. And I look at the overall production and I'm like, Fort Hills is pretty small for Suncor's overall portfolio. So, no, I'm really excited about this one. I always try to find other things that I could bring to different industries, right? And so this one, gasoline demand, steadily improving in Canada. In July was only 5% below 2019 levels. I thought that was important because this number is only up till June, right? It's just the April, May, June quarter. It's nice that they talked about July only 5% below 2019 levels for gasoline demand. And that's what we kind of have been, well, my opinion, we've been kind of seeing traffic on the road and more domestic travel, right? They still said jet fuel is still lagging, which is interesting, right? Because I'm long Spirit Airlines. One of the analysts were like, I thought you were going to use your extra, because they're generating so much free cash flow this quarter, right? With WTI where it was and is. And so anyway, they're like, I thought you were going to pay down more of your debt, because that was kind of their capital allocation schedule. And they're like, well, this quarter we decided to buy back shares. For reference, they bought 1.5% of the company back in one quarter, which is pretty crazy. Anyway, the reason why is that they're expecting their tax proceeds. So when they had those impairments and their operations were impaired last year because oil technically went negative for a bit, basically you get tax return instead of having to pay tax, right? So anyway, they're going to get a big tax return near the end of this year, and they're going to use that to pay down the debt. Thought that was interesting. And then they also are selling a working interest in Golden Eagle, but both of those things together about $1 billion. So that's why they said that they didn't pay down as much debt as people would likely have expected with the cash flow generated. So anyway, Suncor is trading down because of the Fort Hill news, which is very exciting because, like I said, the performance is actually back to 2019 levels. This is in US dollars, so it was 34 US, so about 40 Canadian. So anyway, and we're still down, like we're under $20 US on Suncor's side, so that's like an easy 50% upside, just in my opinion anyway. But assuming WTI stays where it is, like this company's just giving off cash. But it is really exciting because, like I said, they bought back 1.5% of the business in a single quarter with their cash flow generated. So the cheaper this goes, the more bang for the buck on the buybacks. Freeport's just a machine. So Indonesia is back to ramping up to 78%. They're still targeting 100% for the end of this year, which is quite the big jump in 6 months. So I'll have to see if they can execute there. So far, it's been right on schedule. And this one's been really nice to analyze because there's been no surprises. The only change, again, is that before the copper really boomed, they were kind of saying we're going to be in a cash flow machine generation, which they are and still are. But Lone Star is kind of getting more capex, I think, the accelerated amount of capex than what I originally thought they would. Just for reference, just so you can see the Indonesia production kick up, you can see it going from 181 millions in recoverable pounds of copper to 308. That's a huge increase, right? You're going from 118 to 30, basically. It's not a small amount. And then also you have the gold byproduct, right? And Indonesia gives off a lot of gold as a byproduct, so the unit cost is very cheap. So the more production that's coming out of Indonesia for the portfolio of the company, the lower the cost of copper that they mine. And with the copper prices where they are, this company is just insane for cash flow. They hit their debt schedule, so they had like a debt target. They hit it 3 months early because of how strong the copper prices have been. Anyway, and you can see the year-over-year increasing. This is just 6 months cash flow, and you can see going from 450 million for 6 months last year to 340 billion. It's just, 3.4 billion. 340 billion would be a big company. Anyway, they're executing, and the debt's already there, so I'm expecting some shareholder remuneration in the next 6 months anyway, given where cash flow is and where the balance sheet is. They already got the debt target, so pretty sure there's going to be either buybacks or dividends. I'm really, for me, because younger and just how it's set up in my account, I'd prefer share buybacks, but you don't influence that. Anyway, Spirit Airlines, the flying yellow banana, actually turned operating income positive in the quarter, which is kind of what we thought when we heard the Delta say leisure travel was back. So, and you can see the year-over-year comps are very funny. So I'm glad that they put 3 years here just to see them. So you can see their revenues are almost back to 2019 levels. Not quite, but almost back, which is pretty good because they were only 10%. Like revenue was down 90% last year for these airlines, right? They got destroyed. So it's coming back. I did see the loss of extinguishment of debt. I don't know if you guys saw when I did a video about Comstock Resources, they also had a similar kind of thing where they paid debt early, and the banks always get paid no matter what, even if you pay debt early, right? That's what this is. But anyway, the operating income looks really good. Most important factor for me is the load factor, and right here you can see load factor at 84, which is pretty much back to 2019 levels. So all they got to do is keep scaling up, which they already are because they're bringing more planes to the market. I'm trying to go fast here. So I wanted to check into this $331 million loss on extinguishment of debt. The main source of write-down is here, the 295 for debt extinguishment. And anyway, they issued 1% debt, which is pretty cheap for an airline, or convertible senior notes, and they paid down the old converts. And they also used some of the old converts. They converted it to shares and then used some of the proceeds to buy or pay down the 8% senior secured notes. So overall, I think this is smart, but time that it happens sucks because it shows up on the income statement like a sore thumb, right? You're like, how are you back to profitable? Then you have this huge 331 million hit, right? So the EPS, if you look at the bottom line, looks even worse, but really that's just because they paid the debt down early. But yeah, 1% is nice on the debt side, especially in terms of WACC, right? For an airline, getting access to cheap debt is pretty important. Again, so they reference in June, we recorded our first month of profitability since the onset of the pandemic, and based on current booking trends, we anticipate we'll be profitable in both the third and fourth quarter. So that's really good. So we've inflected back to positive. So the bleeding's technically stopped for Spirit Airlines. Technically, it's recovered in terms of the load factor, but the revenue still has to ramp up. And one of the analysts did talk about the pilots and how they didn't let them go, and they said that's a good thing because they don't have to retrain any pilots, rather. So yeah. Anyway, Vertex Pharmaceuticals. So this is a fun one. I haven't done a video on this one. The thinking with this one is that I get the free cash flow of cystic fibrosis. Then I also get the gene editing therapy of CRISPR-Cas9. So what happened during the quarter is I was on CRISPR-Cas9, and then all of a sudden, because it was Intellia had good results, and all the gene editing companies shot up, like Beam and CRISPR, but Vertex didn't. So, and I was long CRISPR, so I sold CRISPR because it shot up from 100 something to 150 and something. So I sold that because I saw Vertex was actually cheaper than almost where it's been for the last 52 weeks. Yeah, right around there anyway. So I decided to buy Vertex. And really the thinking here is that I just get the free cash flow of cystic fibrosis, and I get to participate in the majority of CTX001, which is CRISPR-Cas9, and I think based on the data so far, they've got the cure for sickle cell and beta thalassemia, and it will be the first gene-edited drug that the FDA approves for CRISPR-Cas9. So, and for the world, I think that's a pretty big statement. So I think that's hidden in its umbrella, and there is risk here because it relies on one drug for all its cash flow, but the cash flow is just insane. They did up their guidance on the revenue side, and you can see that here. Their last 6 months, they were only at $3 billion. This year, they're at $3.5 billion, so quite a bit of growth. One of the things that stands out, research and development expense, $1.4 billion in the quarter versus $400 million in the last, so basically $1 billion more in R&D expense, and that's why the bottom line doesn't look as good, right? Because if you had $1 billion back here, you're killing this last year's quarter. So I wanted to dig into that, and then you can see here, research and development includes $900 million upfront payment to CRISPR. So basically, Vertex paid for more of the upside on CRISPR, assuming it's successful, right? And they had some pretty good phase 1 data. The non-GAAP EPS is what matters here because of that R&D noise, right? I wanted to see, well, how's the company actually performing, right? Based on its current fundamentals. And you can see that for 9-month EPS, 6-month EPS, we're at $6. You do a run rate, say 12, you get $12. Their price around 200, so that's at 16 times earnings. So I get 16 times earnings for a company that's growing double digits. And I get the upside from CRISPR-Cas9. So this is just a way to play gene editing without having to pay up for the gene editing. Still looking at Beam, but that's another story. Nat gas side has just been crushing it. Obviously the high prices help nat gas players. This is AAV. I haven't done a video, I don't think, on a nat gas player, but really it's production and the price that they can sell it for. Same as most other energy and commodity plays. They are pretty low cost, but you can see here natural gas, they've only gone up in the quarter 100 from a year-over-year basis, only $1.10. I mean, it's not, from percent terms, it's pretty big, but we know that nat gas hit over 4. So I'm like, well, what are you doing, right? You're at 280. One of the things that happened with this company is that they hedged a lot of their production, so they haven't been able to realize the full effect of the increase in nat gas prices that we've seen. So while production's doing up pretty good, more than 10% on a quarter-over-quarter, year-over-year basis, and the price has done good, they haven't participated as much as I wanted them to. So, but the share price has already kind of reflected good performance, but I think this thing has a lot more room to go just as soon as these derivatives slowly roll off. AAV, so Advantage, does have quite a lot of low cost, so relative to their peers, and that's just where they are in the region. So that's what this slide was that I skipped over, where they are in between British Columbia and Alberta and the Montney formation. Anyway, you can see the performance numbers here. Ultimately, it was more production and doubled the realized nat gas price, more than doubling your revenue. Ultimately, a favorable outcome, which is what you'd expect given where nat prices are. They have kept costs down relatively, which is nice. It just shows the scale, but overall, pretty good performance. One of the things I want to bring out is the swing in derivatives. So the first quarter, this thing really pissed me off because they had $30 million worth of derivative losses. And $30 million for this company in a single quarter is small. You can see that they only did $93 million in revenue, right? So when you, like last quarter, there was 30 million of losses instead of 16 million in losses. So these derivatives are kind of killing the upside of this company, but overall, you can't stop higher production with higher prices, right? So you can see that here. So fundamentally, AAV looks good. Enbridge also reported Friday. They did say that their North America refinery utilization, they noticed that they're approaching pre-pandemic levels. That's important. So pipelines are important for gauging what's really going on because they can see a lot, right? There's not that many of them. So line 3 replacement, most important thing for this company for this year anyway, for owning it still, because it has appreciated quite a bit since it's in the video, at least a little bit for a stabler 7% yielding company. There's always drama on the Detroit side for the line 5. But one of the things that this one was different is that the actual operating income actually went down, which is weird because so far most of the operating incomes that we've gone through, I think all of them actually were positive, inflected positive, but this one actually inflected negative from a COVID quarter, which is funny, right? So I don't know if you guys remember that video, but I said commodity sales and commodity costs generally flow through, and that's true. So the revenue looks like it's better, but really it doesn't really matter because if the revenue is driven by commodity sales, it doesn't really help the company because they flow it through. So you can see COGS also higher, right? But anyway, for this quarter specifically, I saw that, hey, what's going on? I'm 10% weaker in operating income. So when I go to this slide, it kind of tells me what's going on. So Q2 had weaker throughput as expected. You're going from 2.75 to 2.62, and they're averaging their guidance is 2.8. But anyway, you can see it ramping up in Q3 and then accelerating in Q4. And the Q4 is tied into this upgrader, so there's probably going to be some upside there in Q4 for Enbridge. Market should start front running that at some point anyway, because really I think Enbridge should be over 50 easy by now, just given how stable the business is. And I'm surprised they haven't done more reverse impairments, because I remember in Q2, I remember it was Q3 last year, they did some big impairment on an investment they had. Guidance still looks good, they're growing year over year, that's what we thought. ATCO was interesting. ATCO Structures actually didn't do as good as I wanted, but Canadian Utilities really stepped it up here. On the year over year, ATCO is doing well on all their lines, so Structures is better, Forts is better, and the Utilities is better, so ATCO is doing really good on a year over year basis. It's good from a utility perspective. I mean, this might not seem big to you, but 1.5 earnings for 6 months versus 1.7 is a pretty big deal. That's more than 10% of earnings per share increase for utility. I still view this one as a nice way to get some upside. And we've kind of already seen that. I think I did the video at $37, and now it's around 45. So it's a good way to lower some risk, right? Park some money in a utility. It's kind of how I do this one. But I might sell it again. I kind of go in and out of high risk. We'll put it back in the utility that I know will do well, or I think do well. I did want to see why they're doing well on the utility side, because that kind of surprised me. So they said international electricity and international nat gas, blah blah blah, cost efficiencies. So I go to international, and they bring up the Luma Energy Agreement for the Puerto Rico electricity system. So ATCO does have, and CU by extension, has a lot of these international things where they're trying to build up the infrastructure of developing places. And you can see that it's $4 million in one quarter and $7 million in the other, so $11 million more year-over-year increase in EBITDA, which is one of the main reasons why we're up EBITDA year-over-year. So that was interesting. And then on international nat gas, they did say, this is something that I feel a lot of people might not know, is that when you do like a general rate application, a GRA, you can pass through your costs and you get a return, basically. So utilities, assuming they're good at managing their costs, generally they can pass on their costs to the end user through the regulator. So if inflation starts increasing for the utility, like their input costs, like wage pressures and all that, they can push that through and just increase the amount that we pay per day, kind of thing, for using the utility, right? They're just supposed to make the same amount in percent terms. Like say if the regulator allows 8% return for equity and 5% return for debt, they'll just say, okay, you can earn 7% on whatever your expenses are, kind of thing. It's not really explained that well, but that's kind of how you could view it, as a utility is able to push on costs, basically. And it's delayed because the regulator has to allow it, but it's almost always generally allowed because you don't want your infrastructure to be neglected, especially energy infrastructure. You kind of want it there when you need it. Speed up here, last one. So tobacco, British American Tobacco reported as well. EPS was just outstanding. So when I saw this slide, I thought, wow, this is really good. 6% EPS growth, because remember, the thesis was just stable. They get the non-combustible upside, and then the smokes keep slowly degrading over time. But they had 6% EPS growth, which is pretty high. But then when I went to the financials, like after the call, I'll blow it up here, you can see the revenue went down. I'm like, what the heck? And then I see the operating income, right, also down, or profit before taxes and profit from operations both down. So I was like, what's going on, right? You told me your EPS was up 6. I go back here and you can see this big swing on FX, minus 13.3, which totally offset the adjusted profit from operations. So it's like, wow, your FX impacted that much. And yeah, it did. So right here, you can see this slide probably the most important for British Tobacco. And this is still yielding 7% a year, which is pretty nice because the cash flow is just so high. But anyway, vapor. So all these new categories of non-combustibles all growing pretty high, right? 40%, 50%, 64%, 25%, pretty big, right? And your traditional is still declining, and your traditional is still declining. But one of the things that's interesting is that if we look at constant rate, so if the currency conversion didn't screw them in the quarter, you're looking at 50% increases for new categories, right? And then you're looking at a 6% increase in total combustibles. I just thought that was interesting, and they were growing in all their segments, which wasn't the case before. Like I was expecting more declines on the combustible side. For some reason, it's held its own. It's just funny how on the income statement it looks worse when I look right at it, even though technically the underlying business is actually better. It's just a forex translation, and I'm surprised I didn't hedge any of that, right? But anyway, that's 10 companies. I tried to keep it under 20 minutes, a little bit over. Anyway, have a great rest of your week.